Price to book ratio, my friend. This has been, this has been something that I thought needed to be brought forward for a while now. We talked price to, we've talked price to earnings PE ratios. We've talked PEG ratios. I want to talk price to book ratio today because the reality is when you're looking for value, okay, so we can separate fundamentals into two spaces here. Okay. You can separate it into value investing and growth investing. And so in my lab, we're going to go down both those avenues because both those avenues require different metrics, of which we're going to explore every week, different metrics to really be able to find the companies and the good quality fundamental companies that you want to do either investing, position trading, or even swing trading for certain things. So, when we start looking at this stuff, price to book ratio, for me anyway, I'll just give you the layman's terms, the way I look at it. It's a way to see value by taking out all the fluff that can be in a company. Okay, so let me give you the definition, and then you'll kind of understand why I say taking out all the fluff. Basically, it's just the value of a company if you sold everything off today. Okay, so if you sold plants and equipment and investment portfolios, and you just sold everything the company has, it would be the value of that company. And so the formula for it is basically just the stock price divided by the book value per share. So how much is it really worth at the end of the day? And the reason I like this particular metric more than others is if you're looking for a value company. So value companies, so if we think about value versus growth, okay, and if you kind of just think about it in layman's terms, growth, you're kind of looking for these new exciting companies, maybe bringing a new product to market. You're thinking, okay, can these things grow up to be, the Teslas of the world, or even the Microsofts or the Apples of the world, right? That's what you're looking for in that growth. But when you look for value, what can happen is, the growth component of a well-established, long established company can be very, very thin. Okay, so you may not be able to find value in the growth portion of it. Now you may look for value in dividends, which we do a lot, and there are other things that we look for. But if you just look at value as what the company is made up of, right? When you kind of look for that, there's a way using the price to book ratio where you can see, okay, what is this company actually worth at the end of the day if we had to shut it all down today? Okay. And so, why is that important? Well, again, we kind of just talked about if you don't have a lot of a growth component in a value company, and let's take something like Coca-Cola. Okay. Well-established company, been around for 100 plus years. It doesn't really grow that much year after year, right? And there's lots of companies like this. When you get so big, when your market share gets so big, it becomes harder and harder to grow at a specific rate. Okay. So then we look at value, we can start to say, okay, well, if I'm going to put my money into a company and I'm looking for value from it, what if the company had to close today? How much value would I get out of it? Well, there's two ways to look at that. So if they had more value, book share value, then you have to pay price for it. Well, then you'd actually look at it kind of as a bargain. Okay. If you looked at it the other way and saying, okay, well, they don't have quite as much as I have to pay for it, but there's a ratio there, I can say, okay, is that ratio fair? Is it fair value? I think that's a great term to use, is fair value. So price to book can be really good because it helps get rid of all the kind of stuff that doesn't add to the actual. It adds to the overall market cap of a company, right? It over the overall value, but there's stuff that if you had to sell it all today, if you think about liquidating your household, if you had to liquidate it all today in a yard sale, what would the actual value of the tangible items be? And again, it's like buildings, land, equipment, bonds, stocks, whatever they've got, anything that of value that could be sold. That's what your book value is. Okay, so then you can see how much are you paying for it. What's not in that calculation, which I think is very, very important, is something called goodwill or intangible items. So there's a few goodwill things, or a few intangibles, sorry, that a company has that are not really, they don't show up in that book ratio. Okay. goodwill, brand loyalty, market domination. All of these things don't come into this calculation. So this gives you a really clear breakdown of really what the company is worth at the end of the day. Now, why would we use this? Well, again, maybe I'm bargain hunting. Okay, maybe there's a company out there, maybe they've got 10 billion in equipment, but I'm paying a share price as if they only have 5 billion in assets. Right. Well, then I can look at that and I can say, okay, maybe that's a bargain. Maybe that's a value play that I can get into. And that then you can start looking at, okay, what does the company do? How far are they going to go, et cetera, et cetera. Maybe there's some growth in there. That would be ideal as well. But it gives you an idea of tangible value. Okay. So that's the important part of this. So the other thing that comes out of this is, it looks at the assets after depreciation. Okay. So you go and build a new factory, 10 years down the road, that factory is not worth as much because they take the depreciation out of it. This book ratio, this book value per share also takes that out of it. So it's still a subjective number when you think about it. What is something actually worth? Well, it's only worth what someone will pay for it, but they do a pretty good job usually of looking at it and saying, okay, this is what we think the value of the whole thing is worth. And that's when we want to start looking at it from a value standpoint. Now, we can use this in two ways, right? We can compare company to company, okay? And we can also compare just straight value numbers. One of the things that I was taught many years ago was if you can get a company that has a price to book ratio of under 1, that's considered a solid investment. Okay, I don't really like that arbitrary number myself, but it is something that when the industry insiders are kind of looking at stuff, they do use that as a value metric. For me, I kind of look at it and say, okay, maybe I'm torn between two companies where I want to put some money to work, fundamentally speaking. And I see, okay, one's got a price to book ratio of 10 and the other's got a price to book ratio of 11. That means I'm paying 11 times for the one company for the same amount of assets that I would have got with the other company for 10. So in that vein, I could say, okay, there's value there. So one of the things I like to do here is I'll go into FinViz here, and you can just throw in any ticker symbol. Now, we've been doing Coke and Pepsi, so I'm going to stay on that little theme here. So if we go down here, you'll see P/B price to book. So they're 11.18. Okay, so what does that mean? Well, in and of itself, it means you're paying 11 times the price for the assets, the hard assets that they have. Okay, well, what does that mean? Well, it doesn't really mean much unless you compare it to something else, right? So I go to PepsiCo and I can say, okay, well, similar industry. Well, let's look at this. Oh, so they got a price to book of 13, almost 14. Well, that means I'm paying a little bit more for Pepsi for the same amount of assets. That matters when times get bad. If I'm hunting for value, I really want to have that number as low as possible, even if it's an established company like this. Now, maybe I'm going and I'm hunting for companies that I'm looking for value to build on in the long term. Well, I can go into the screener here in FinViz, and I can go in and just add a few little quick metrics here. I'm going to say over $10 here. And then I can go into fundamental here. I can slap down price to book right here. Okay. I can go less than 1. All right. This is going to give me a bunch of companies here, right? There's 20 of them here, 9 pages of them, 20 per page. So now I've got a list of companies that I know their price to book value is fair, right? It's or maybe even not even fair. It's potentially a solid investment. Now, of course, you have to do more fundamental analysis to see what the companies do. But this is a good way to kind of, use that number to say, okay, these companies, Aaron's company, I think they're a furniture company, rental and leasing services, right? They obviously have some assets and they have some value to those assets. And I now know that I have to pay, less than 1 to get involved with their stock. So from a value standpoint, that's where price to book can become very, very important. So you got 2 little ways to do it here. You can use it to screen for companies that you're interested in, and you can also use it to compare other companies. So at the end of the day, what we're looking for is what am I paying for what do I get? And with the price to book ratio, you get a very clear vision of what the actual assets of a company are when you take all the fluff out of it. And that's kind of how I use the layman's term to understand it.